Hey everyone, welcome back to the channel. I am Juliet, and in today's video, we are going to tackle the world of financial accounting, one of the most important but often misunderstood parts of business. Whether you're a business owner, investor, accounting student, or just curious, by the end of this video, you'll have a solid understanding of what financial accounting is and how it all works. So let's jump right in. Let's start from the top. What exactly is financial accounting? In its simplest form, financial accounting is all about tracking, recording, and summarizing a company's financial transactions. But what does that really mean? Think of it like keeping track of your household expenses, but on a much bigger scale. Every time a company buys something, sells something, borrows money, or spends cash, it gets recorded. These transactions are then turned into reports called financial statements. These reports help people outside the company, like investors, creditors, and regulators, get a snapshot of the company's financial health. That's why financial accounting is so important. It gives external stakeholders the information they need to make informed decisions about the company. Now that we know what financial accounting is, let's take a deeper dive into why it is critical, especially for those of us who invest, lend, or do business with these companies. Now, why is financial accounting so crucial? Imagine you're looking to invest in a company. You wouldn't just throw your money at any business without knowing how it's performing financially, right? You will want to know if they're making money, if they owe a lot of debt, or if they're likely to grow, how it's performing compared to others in the same industry. That's exactly why financial accounting matters. It gives you the data you need to evaluate these questions and make decisions based on hard facts. Investors, creditors, and even company management rely on this information to decide how to move forward. Now, you might be wondering, how do we make sure everyone is reporting their financials the same way? Great question. Let's talk about the standards that make financial accounting reliable. Financial accounting needs a set of rules to ensure fairness, consistency, and transparency. These rules help keep financial statements accurate and comparable, which is crucial for external stakeholders making important decisions. These rules are known as accounting standards. Now, there are different sets of rules companies can follow. The most common ones are GAAP, Generally Accepted Accounting Principle, which is mostly used in the US, and International Financial Reporting Standards, IFRS, which is used in many other parts of the world. While both serve the same purpose, creating consistent and reliable financial reports, they do have some key differences. GAAP is developed by the Financial Accounting Standards Board, while IFRS is set by the International Accounting Standards Board. Companies in the US typically follow GAAP, while companies in Europe and many other countries follow IFRS. And for publicly traded companies in the United States, they must also comply with the rules set by the SEC, ensuring their financial statements are audited and meet legal requirements. All right, let's take a closer look at one of the core concepts that keeps everything in financial accounting balanced: double entry bookkeeping. Now, you might be wondering what's so special about this? Well, think of it like a built-in check and balance system for every transaction that happens within the company. This system ensures that every transaction affects at least two accounts, keeping everything balanced. You see, for every debit entry, there is an equal credit entry. If one account increases, another account must increase or decrease depending on which side of the accounting equation the account resides. This maintains the fundamental accounting equation balance, and the total of assets equal the total sum of liabilities and equity. For example, if a company borrows $50,000 from a bank, the cash account goes up, but so does the notes payable account. In this case, cash is the debit and notes payable is the credit. This system ensures that no matter what transactions occur, the accounting equation stays balanced. That means the company's assets will always equal its liabilities plus equity. No exceptions. If you want to learn more about this concept, I have a video dedicated to this concept, and the link is down below. So now we know how transactions are recorded, but how do we decide when to record them? Let's talk about two different accounting methods: accrual accounting and cash accounting. Now, we have to decide when to record transactions. Do we wait until the cash comes in, or do we recognize them when they are earned or incurred? This is where accrual accounting and cash accounting comes in. Both are methods for recording transactions, but they do so in different ways. Let's use revenues as an example. In accrual accounting, revenues are recorded when they are earned, not when the money comes in. For example, let's say a magazine publisher sells a year-long subscription. They get $24 upfront, but they recognize $2 in revenue each month, aligning with the fact that the service is being provided over time. In cash accounting, you only record the transaction when the money actually changes hands. So the same publisher will recognize the full $24 in revenue the moment they receive the check. Accrual accounting gives a clearer picture of a company's financial performance and stability over time. Now let's break down the financial statements that result from all this hard work in accounting. Companies issue 4 financial statements, and they each tell us something different about the company's financial health. The income statement shows the company's profitability during a specific period, listing all revenues and expenses. It helps you understand if the company is making money or losing it. The balance sheet gives you a snapshot of the company's financial position at a particular moment in time. It shows assets, liabilities, and stockholders' equity. Basically, what the company owns, what it owes, and what is left for its owners. The statement of cash flows is all about cash management. It explains where the company's cash comes from and where it goes. It's divided into 3 parts: operating, investing, and financing. Understanding this is crucial for evaluating the company's liquidity and ability to meet its short-term obligations. Companies also issue a statement of stockholders' equity. This one shows the changes in the equity section, such as net income, dividends, and stock buybacks. So why does financial accounting matter? Well, without it, investors and creditors will have no way of understanding how well or poorly a company is doing. These financial reports give a roadmap for making decisions, from buying stocks to securing loans. They are the foundation of trust in the financial world. And that is it for today's video. Whether you're an investor, a business owner, accounting student, or just curious about how companies keep track of their money, understanding these basics is a great starting point. If you find this video helpful, don't forget to give it a thumbs up, subscribe to the channel, and hit the bell for more content. Got questions? Drop them in the comments below, and I will see you in the next one.